Well, the big day came, the Fed announcement on the 18th of a 50 basis point cut to the Fed funds rate, and mortgage rates actually went up. How in the heck did that happen? Well, I'm here to try and explain some of the details behind it. But as a quick reminder, the Fed fund rate is not the same as mortgage rates. The Fed fund rate is basically the overnight rate that banks charge each other to lend money to each other, and it affects things like credit cards, car loans, personal business loans, short-term securities, things like that. But it is not directly tied to the mortgage interest rate. So, as oftentimes is reported, sometimes people think, oh, well, gosh, mortgage rates went down 0.5%, and that is not the case. In fact, they went up a little bit. So we want to kind of explain that. Some other background information: the Fed meets 8 times a year, but the bonds that drive how mortgage rates work, oh my goodness, they're being influenced by that every second. So mortgages had a head start going into this to come down, and they have definitely come down. We're in a very different position than we were even a few months ago, and a radically different position than we were this time last year. So I don't want that to get lost in the shuffle, that even though rates went up a little bit, that's still very good news because we've come down a good bit. But everyone was kind of expecting that with a 0.5 basis point cut versus a quarter, which was kind of what the odds were going into this up until about a couple of weeks ago. People thought, oh gosh, mortgage rates will get better. Well, they didn't. So we're gonna dig into that a little bit more. At the end of the day, the press conference from the Fed meeting on the 18th was a little less friendly than you might expect. But again, we do have some background information we can share with you. I want to start by thanking our friends at MBS Highway, and specifically Dan and Barry Habib. They have put together a presentation that will help us convey this information to you, I think, in a far more concise way. So let's dive into some of the details. I've shown you this chart several times before. This is the U.S. mortgage-backed security, sometimes called the 30-year coupon. Generally speaking, green is good, red is bad, and it's inversely related to the direction of rates. So all of this upward movement since about the beginning of July has just been a continual improvement in mortgage rates, which is welcome news. Well, here we are the day before the announcement. Rates got a little bit worse, then they got worse the day of the announcement, and they've been kind of just trying to recover and figure out their ground. Well, that's because the market is trying to figure out what's going on and what all of this actually means. So let's kind of dive a little bit here deeper. So the Fed cut their rate by 50 basis points to 4.875, and their Fed fund target rate range is 4.75 to 5. So they're right kind of in that target range. There was only one Fed governor that dissented and only wanted the 25 basis point cut. Notably, that's the first governor to dissent in 19 years. She has typically been, throughout this whole process, someone who's been more hawkish and wanting not only rate cuts, but has even proposed a couple times rate increases. So interesting. Also, I think it's really good information to kind of really put our arms around this. The Fed has a dual mandate: stabilize prices by way of inflation and maximize employment. So right now, as we see that inflation's starting to come down, the focus is much more towards employment. I'm going to share a graph with you, again, that the folks at MBSI have put together that will help show the picture a little bit better. But they're a little more confident that inflation is going to continue to move towards their target of 2%, but they're much more concerned about employment. In fact, they say job gains have slowed. Previously, they said moderated. So they're starting to see that the job market is softening, and that as they get to some critical targets and what the unemployment rate is, it's going to change more of their decision making. The economy is still solid. However, there are some side notes to this because there's a lot of spending that's happening in what they call deficit spending, which is just on credit cards and other kind of short-term debt. So we need to kind of keep an eye on that. The other thing is they're going to continue with quantitative tightening, which just allows the Fed to kind of have things roll off their balance sheet. All right, so the summary of economic projections, the SEP, it's every other meeting. So this meeting on the 18th was one where they released it. And so, the Fed funds rate, 25 basis point cut November 7th, and then another 25 basis cut on December 18th, for a total of 100 that by the end of this year, and another 100 for 2025. Now, that is part of why the bond market and the market in general is trying to digest this. The stock market loves this, by the way, but the bond market is really trying to figure out its footing on this as it reads through all of it. Inflation numbers currently at 2.6. They believe that we'll probably end up right about 2.6 because we've gained about as much as we can on inflation so far, and that by 2025 we'll be at 2.2, and at the end of 2026 they should be at that coveted 2.0, what they call core PCE as their target. Unemployment rate, we're currently at 4.2. They expect 4.4 by the end of this year, so it's going to continue to go up. And they believe that if their actions are effective, they'll keep it at 4.4. But I will show you a slide that has a very big impact on all of this. And GDP currently at 3%. We're thinking we're going to be 2% by end of 2024 and 2% by 2025. All right, so this is the Fed dot plot. I've shared this a couple of times. It's kind of an anonymous survey of all the different voting Fed members that says, hey, what do you think is going to happen, or what would you vote for by way of either a rate increase or a rate decrease? And so it's kind of oriented by year. So this is 2024, 25, 26, etc. So for the rest of 2024, we have two governors or two voting members that say, hey, we think it should be 0. We don't think we should do anything more. We've done all we should at the 0.5%, and that's that. There's 7 that think they should do a quarter basis point reduction, and then the majority, which makes it the median, 9 of them believe that there should be a 50 basis point cut. So that would make a total of 100 basis point cut, or 1% drop for 2024. And there's one member that believes it should be a 75 basis point. As we roll into 2025, we can see that the vast majority want at least 100 basis point, if not 1.25 or 1.5. We only have a couple, 4 total, probably 5 total, that are under that mark. But as you can see, the line is pretty clear that there's an understanding that there needs to be additional cuts. All right, so I'd mentioned that there's going to be a discussion on unemployment, and so this comes from the Fed's projections. And so just to orient it at what's going on here, this little dashed blue line is the last time that in June, when the Fed members were polled, hey, where do you think unemployment is going to end up? And here's where they all voted or kind of guessed. At the end of the day, most of them are wrong because, as we know, we're at 4.2. And so that's kind of where we are here. Looking forward for the September projections from this most recent meeting, we have about 9 that think it'll be between 4.2 and 4.3, and 10, 4.4 to 4.5. 4.5 is kind of a really critical number that if it gets that high, then they'll have to take even more drastic action. But like everything the Fed does, they're trying to balance what makes the most sense and how to put all of this together and not overreact, but also not take too long to get there, which some would argue they have done, taken too long. All right, so last little bit on this, the press conference. The Fed doesn't see a recession, but they see that spending and growth have remained resilient. This is where I mentioned earlier, it's a lot of deficit spending. We have seen the highest amount of credit card debt in history occur over the past few months, and the sharpest increase as well. So not only just the total amount, but the increase. There's a lot of people buying stuff on credit and using right now dollars instead of future dollars. That's going to change the landscape down the line, but that's what we're seeing right now. They've said that 50 basis points should be seen as their commitment to not fall behind, hence what we saw on the 18th. They don't think they're behind the curve. Some might say otherwise. And 50 is not the cadence that should be expected. And I think that's really where the market's trying to dissect it is this going to continue? And this is why mortgage rates actually are a little worse as a result of all this. They talk about market rents decreasing, but slowly, and it'll take time for lower rents to filter into inflation readings, which is a really kind of key part of how those numbers are coming to be. So this was a longer-winded explanation than I would normally do in a video, but it was important that you see the full picture to be informed on how all this comes together. So we love talking about this. If you need additional help in kind of putting your arms around it, we'll be happy to do so. Otherwise, our job is to make sure you have peace of mind, and education like this is one way we do it, and we appreciate the opportunity. Thanks so much.